So these three three discount arrays are inside of the premium range right before we get to our target. So if this is our target up here and the inception of the move was down here in the volume imbalance, we're in the upper portion of it. So we don't want to add to anything. We don't pyramid in that portion. So we have to just manage the trade idea. And now we have 1, 2, and the volume, the fair value gap here that's already traded into. Now we're in the volume imbalance. And then the mean threshold of the order block, that has to be supported to price. If it trades and closes a body below that, that's problematic. Then you'd have to take something off the trade, reduce the leverage that you have open. And that's the only time I give permission to a student to take something off when the trade's moving against you while still being in profits. In other words, you're having open profits erode as it's going down in here. But just like I was teaching a little while ago about when you want to kill the trade or abort it, when it no longer makes sense, you're closing the trade before it hits your stop, but you're closing the trade while it's taking more from you. But you're limiting how much it is. Well, in this case, it's taking open profits that's unrealized while it's retracing against you if you're hypothetically long back here or in here. So you can't look at it as, well, I can't take a partial off now because I'm doing it when it's going against me. But you have to do that if it closes below the mean threshold of this order block, because it might be indicating to you what? It's going to come back on your stop, which may be trailed. It may not be trailed. Regardless, you want to reduce the leverage and reduce the exposure to risk, because it's indicating that we are possibly either consolidating or retracing, and it's Friday, and we're transitioning from the morning session into what? The lunch hour, where stops usually get rolled against. In other words, who's been making money this morning? The longs. So where's their stop loss? During the lunch hour, or just after it, the typical performance in prices, it usually rolls against the liquidity that was raised up during the morning move higher, and either it goes for them and continues lower, or it goes against it, hits that liquidity, and then continues going higher. Either way, it's likely to run against the sell side because we've seen delivery on the upside all morning. Does that make sense? The fact that we don't want to be buying up here in a premium relative to our target, we're using discount arrays to filter out the willingness of price. Does it want to go higher? Does it keep giving us indications that it wants to go higher? I use 3 PD arrays to do that. The most immediate PD array relative to market price, which is right now where we are ahead, right here, the volume imbalance, the fair value gap, and the mean threshold of that down close candle, which is the order block. That's the last line of defense. So far, we're seeing short-term support offered by the volume. I would have loved to learn how to abort a trade and not let my stop loss get hit when I was 20 years old. These are things that I wanted to find in books when I was buying them. Teach me how to do that. Teach me when the trade's no longer good. Books never talk about that, and it's very frustrating, especially as a new trader, because you only have the get me into a trade ideas given to you, which is the least important thing. The understanding of what makes a trade less probable. When do you get into a trade that looks high probability, and when does it change from high probability to it's not likely to pan out? What are those factors? What are those things that leads to that occurring? So that way you as a trader can use that analysis concept to mitigate unnecessary stop outs at full risk, or abort the trade before it turns into a losing trade. Those topics, they're just not available, and it was a very serious point of frustration for me. So I had to go in here and just make up my own rules as I went. What do I do? How did I lose? What caused me to go into a downward spiral and caused me to blow my account? What were those things I was thinking about? What was I fearful of? What was I overconfident about, but then price told me that wasn't likely? What were those things that keep happening? That's what I did. And that's the language I'm teaching you. All those core content lessons from my private mentorship That's the language. That's not mentorship. This, what I'm doing with you right here, that's mentoring. Now imagine you have been waiting for me to do a mentorship and you paid. You're in there and you're watching something like this. As a new person, you're thinking, you should be telling me to get in good trades, like it's a signal service. No, I'm teaching you how to read price so that way you can do this on your own and navigate it and not feel the tug of war, the emotional and psychological impacts of being right or wrong, being confused, needing to wait for more information. All of that brings to the table as a trader. And knowing what you're supposed to do, how you're supposed to think, how you're supposed to react to what you're seeing in price action as it relates to you as a trader, not reacting to price for trades. You have to make the reaction to what the indications of these price movements are telling you. You can't stick with a trade when I'm teaching you the signatures are telling you it's no longer good. If it's doing that, it's indicating to you that it's problematic now. It's not likely to pan out. So what do? You either abort the trade or take half off. That was something for your journal, by the way. It's not the first time I mentioned it. But when you have three PD arrays break that were supposed to be supportive for your trade, if they break, that's the clearest indication that you're probably in a reversal and you just don't have the experience yet to see it. And there's going to be times when you do that and it turns around and keeps going in your favor, but you don't have the experience to know that's going to occur, which is the reason why I give that rule-based idea to my students. In the early stages, you don't have the experience, which is something that has to be acquired on your own. I can't write a book. I can't do a video. Nobody else can do it either that gives you that experience. That experience has to be earned. You work for it. And a lot of lazy students came to me and would see things like, this is how I was teaching. This is how I was doing mentorship. I was talking about things and making you understand this is what it's going to feel like to be doing it. And sometimes the price isn't going to do what you want it to do. How are you going to perform as the trader? What are you going to do with that? How are you going to manage the risk? How are you going to stay with the trade, if at all? What are those defining moments in price action so that way you're not caught off guard, you're not surprised. So that way you're relaxed. You're just listening to what these candlesticks are telling you. The only time that you should be shocked or taken back is if some violent thing comes in where the market just does some crazy ass up down move, something, some war event, some kind of terrorist attack, that type of thing, where nobody can see that coming. And then, boom, there's all kinds of shock and awe in price action. You can't avoid that. Nobody can. That's the inherent risks of trading. And your stop loss might not even do its job in those instances. You know that that's likely to happen. When you sign up and start with a brokerage, whether you do it with a funded account, I don't know what the risk disclaimers are. I don't even think there is any risk disclaimers. You sign for that.